Hello and welcome back to the American Dream Portfolio. In the last video, we learned how dollars accumulating due to the power of compounding are much like a snowball rolling down a snowy mountain. Initially, it only adds a few snowflakes to itself, but eventually, it adds chunks of snow and even pieces of earth to its bulk. In your money account, this added size comes from new dollars that stick to the dollars already in your account. If given enough time, your account will contain more sticky dollars than the original dollars you put in. These sticky dollars are thanks to the power of compounding. You did not have to work for them. Okay, but in our analogy, what is meant by the size of the mountain? This relates to the amount of time your money is working for you. The larger the mountain, the longer the path traveled by the growing snowball, which is your account. Remember that time is one of our 3 important variables for investment growth. What about the steepness of the mountain? Well, the steepness of the mountain by itself doesn't mean much. It only has significance when combined with the power of gravity. When we put the two together, we get a fast-moving, rapidly growing snowball. So what could cause our initial deposit of dollars to grow rapidly? Well, that would be another one of our key variables. The rate of return on invested money. The greater the rate, the steeper the mountain, and the stronger the effect of gravity. So it's not an exaggeration to say that the power of compounding is analogous to one of the fundamental forces of nature, gravity. Maybe this is what Einstein was getting at. What about the third variable that determines investment growth? The amount of money invested. This could be thought of in 2 ways. One way is to start at the top of the mountain with a bigger snowball, meaning a bigger initial deposit. The bigger the snowball you start with, the greater will be its ability to attract large amounts of snow in the early part of its journey. This added power of attraction at the outset will compound as it rolls towards the bottom. Another way to think about this is to add snow or dollar deposits as the snowball is rolling along. Whatever dollars you add along the way will attract additional sticky dollars to your account, which will provide extra horsepower to the compounding effect. Okay, this all sounds pretty reasonable in theory, but is this how compounding works in practice? In other words, in the real world? Well, not exactly. So what's the problem? Well, there is no problem, so long as your invested money is earning a fixed rate of return. Remember that the rate of return is analogous to the steepness of the mountain and the force of gravity. If these 2 factors don't change, then our analogy holds up. But if the return is variable, all bets are off. A variable return means the mountain is taking on weird and improbable shapes which alter its steepness from time to time, affecting the snowball's progress. So we need a fixed rate of return for the analogy to make sense. But what investments offer a fixed rate of return? Let's consider this question. We introduced this topic in earlier videos, but let's revisit it in more detail here. All investments, by definition, offer some sort of return, or promise to. That return can come from income, from appreciation, or both. But to the extent that a return on investment comes from appreciation, it would not be fixed. This is because there are no assets that appreciate at a fixed rate. Think about investments that might appreciate: stocks, bonds, real estate, commodities like gold, fine art, private businesses. None of these appreciate at a fixed rate. Their value depends on supply and demand, which are always in flux, and on other factors. So what about income distributions like interest? Can the rate of return from these distributions be fixed? It can, indeed. Not all income, mind you. Dividends are passive income, but the rate of return from dividends can and does fluctuate. We'll discuss dividends in greater detail in future videos. Where does that leave us? It leaves us with interest payments from a bank or a similar arrangement. Interest payments tend to be fixed, at least for a while. These would include checking and savings accounts, certificates of deposit, and money market accounts. But again, the fixed rate of interest is temporary. Fluctuations in inflation and other factors cause interest rates to change. Is there any investment with a fixed rate of return for a longer period than a few years? Yes. Long-term bonds issued by the US Treasury, by other governments, and by corporations. In the US, Treasury bonds can be purchased that pay a fixed rate for up to 30 years. So we finally have an example of compound interest that fits the stereotypical explanation. The US Treasury offers a mountain with a fixed steepness and force of gravity for 30 years. Are there other private sector options besides bonds? Again, focusing on the US market, we find that insurance contracts called fixed annuities pay a fixed rate of interest for up to 10 years. Then they typically reset in response to changing market conditions. The problem is that most discussions of compound interest assume a competitive fixed rate of return, like 8 to 10%, for a lengthy period of time. This is simply not realistic. For example, we are often told that the major US stock market index, the S&P 500, earns an average annual rate of return of about 10%, with all the benefits of compounding that accompany that return. The problem is that the S&P 500's return fluctuates, sometimes dramatically, from year to year. Yes, we can compute an average annual rate of return for a given period, but what period should we select? What period is relevant to our circumstances and goals? Let's do a little research and see what we can learn. If we look at 10-year average annual returns for the S&P 500, we get the following sample of results, with dividends reinvested. 2016 to 2026, plus 15.48% 2009 to 2019, plus 17.28% 1999 to 2009, minus 3.91% 1995 to 2005, plus 9.79%. So which 10-year period is most relevant to us today? The most recent one? The best one? The worst one? What about those who point out that comparing longer periods of time, say 30-year periods, will give us much less variability of result, and the results will be closer to 10% per year? They are correct, but how relevant is a 30-year average return to an investor who just experienced an average loss of 3.91% per year for 10 years? That loss would be like your money ball rolling up the mountain for 10 years, shedding sticky dollars and getting smaller as it went. Not a very pleasant prospect. As to what is the most relevant time period to consider, that is a question you have to answer for yourself. Our point is that those who are cavalier about touting the 30-year benefits of compounding without regard to the variability of shorter-term results, like 10 years, are doing their audience a disservice. Humans are much more reactive to short-term results, especially dramatic ones, than to long-term averages. And so, understanding and applying the power of compounding is not as easy as some make it out to be. But we will pick up this subject in the next few videos. We welcome your comments on this topic and will see you next time.